Hello and welcome to All Things Money. I'm your host, David Blain. Thank you for joining us today for our third segment of the show. If you happen to miss the first couple, it's been a great show. I advise you to go to our website, www.dlblain.com. There you'll find archived copies of the show and you can catch up what we were talking about. We're going to finish this segment talking about what to look for in the fourth quarter. Last segment we talked about looking at the economic conditions, namely the unemployment rate and manufacturing data. We also are looking at the earnings of the companies as they announce their third quarter earnings. That these things and the rest that I'm going to talk about in this segment will largely determine, I think, whether we continue with this risk on, meaning that risky assets are moving up in value, or the risk off, where things are going down in value, which was prevalent in the third quarter. So let's move on to one of my favorite things to look at when trying to determine what's going on out there is look at the market itself. The market itself is a wealth of information. If you think about it, on any given day, the price of the market, whether it's rational or not is another thing, but on any given day, the price of the market is in fact the aggregate thought process of all the participants in the market. Is that they're buying and selling, and this process of buying and selling brings the market to a certain value for that day, which by definition is the aggregate thinking of all the participants in the market. Once again, this is not, sometimes it's not very rational. At the lows in March of 2009, it was probably a little bit overdone, but the point is that on any given day, that is what the market comes up with for a value. So we like to look at, in aggregate, what are the market participants saying about the market themselves. And what we've seen is since the lows on October 3rd, we've seen a nice upside participation. We see that about 65% or close to 65% of the industry groups are now in upward trends for the S&P 500. So this is a good sign. Once again, look at the market itself. It's the aggregate sort of opinion of millions of people from around the world as to the direction. And what we think is that the market goes to extremes. And once those extremes are reached, then reverses. And we see that back, I don't know, I think it was late September, early October, we saw that only about 15% of the industries in the S&P 500 had any sort of upward momentum. That's a little bit overdone. So we like to see that as good entry points. Number four that we're looking at is, of course, Europe. The U.S. has continued to outperform Europe by a wide margin, and we think that Europe has got to get some things straightened out. The U.S. does have the ability to somewhat move in its own direction away from Europe, but certainly a global recovery. We definitely need Europe to get back on more solid footing, figure out what's going to happen with Greece, figure out what's going to happen with Italy and so forth. And we see that European markets have made a nice rebound, in fact have been slightly outperforming the U.S. market since this rally on October 3rd, and that's a good sign as well. We need Europe to get their problems fixed. For the global economy is so intertwined that we cannot have a major region like the Eurozone having significant problems. The fifth thing we're looking at, of course, is the banks. The rest of the world should get some confidence if we see Europe performing better, and of course for Europe to perform better, we're going to need to see the European banks perform better as well. And in fact, that is what has happened. The European banks' relative strength has been increasing. We also had a little bit of a scare, I think, with Bank of America here in the U.S., but we need the banks in Europe to get on solid footing, so we're keeping an eye on that carefully. China. China also is its relative importance in the world, even though it only makes up 2 or 3% of the world market cap. It is the world's second largest by GDP, and so we like to take a careful look at the stock market for China, which has simply been dreadful for the past year or so. But when we see the past couple of weeks, it's been doing very well. It's been outperforming It's up over 20% in the 8 days from its low of October 5th through the 17th. So a significant rally in the Chinese market. Chinese market has somewhat of a leading tendency. It tends to recover before economies as well as start to decline before other economies. It's turned into somewhat of a decent indicator the past few years. The same thing goes with our seventh thing we're looking at, which is emerging markets. Of course, China is the largest emerging market, but there are other emerging markets such as Brazil and India, Russia, some of the Eastern European countries, some of the Asian countries, Malaysia, Indonesia, places like that that we're keeping an eye on. As their momentum moves upward, we see the low debt, the increasing population, the consumer populations over there, that they have been the driver of a lot of the global growth the past few years. So we want to keep an eye on that. Currencies, kind of the same thing. In risk-off scenarios, people flood to the dollar, the Japanese yen, things like that. So we look at currencies. Are people moving back to things like the Australian dollar, the Brazilian real, things like that? And yes, in fact, we see that has been happening, that these emerging currencies as well as the riskier currencies, we're seeing upswing. So that bodes well. The commodity demand theme, which sort of encompasses a lot of these factors, the demand for commodities the past 10 to 12 years has been a significant driver of global growth. So we're looking at what is the demand for commodities. Commodity demand has, in fact, picked up. And simply aggregating a lot of these things is what we call the risk-on, risk-off trade. The past 5 or 6 years, this is the way the market's been going, is that anything with risk, such as stocks, commodities, oil, things like that, have been moving in tandem. Then your long-term treasuries, the U.S. dollar, consumer staples, utilities, things like that, the risk-off trade has also been moving together. So we look at these baskets of securities and we get this risk-on, risk-off trade. And we see that the risk-on is definitely back in vogue after the October 3rd lows. So once again, just to kind of recap the things that we're looking at in the fourth quarter, the economic conditions, employment, manufacturing, earnings of the market itself, we're looking at the tape, Europe, banks, China, emerging markets, currencies, risk on, risk off, and commodities. So that's about all the time we have. So for All Things Money, I'm your host, David Blain. We hope to see you again next week.
The proceeding was a paid program. The opinions expressed are not necessarily those of WNBU and Inner Banks Media.